how to do cash flow analysis so you can choose the right property. So most investors in Australia only ever buy 2 investment properties and fail to build a property portfolio because of 2 reasons. Number 1, they poorly structure finance for their investment property portfolio. And number 2, they do not do cash flow analysis of the deals that they are purchasing. So often they end up purchasing a property based on how it feels to them. And whilst gut feel is important, it is more essential to do your cash flow and your figures per deal that you're considering. So in our journey, when we were buying our properties, every property that we considered to add to our portfolio, we did the numbers on. And there's a few things that you need to consider.
Yeah.
So there's a few things. So firstly, you do need to look at the loan that you'll be taking out and how much deposit you'll be putting in. Stamp duty costs plus any legal costs, any B&P costs, building and pest that is. So you need to look at a few things when you're doing your cash flow. So number 1 is really looking at what deposit you're putting in, the stamp duty, the legal costs, the building and pests that you'll be paying for, and any other incidentals that you're paying for. And also then you need to do your cash flow based on the rent that you are collecting for a property. And from that you take into account the interest payments, the water rates, council rates, agency costs, insurance, that includes landlord and building insurance. And then you do an analysis of what is my net cash flow from that, what is the net of income minus the expenses that I'm incurring, and you do it on a weekly basis and on a monthly basis and an annual basis.
So you need to look at what the income would be, and less the expenses will give you your net cash flow per month, per year and weekly. So you must analyze the cash flow, and there's other benefits as well that you can look at. There are obviously tax benefits, depreciation benefits. You will have the LMI tax deductible over a period of time, which your accountant can help you with that. But make sure you always analyze the cash flow and tie it into your actual strategy around what the rental return you're targeting and what the property should hold. So looking at the numbers should tell you whether the property will be negative, whether it will be neutral or positive.
And it's vital, because then you'd be able to look at whether you have the risk profile to be able to afford that property on a month-on-month basis. And also to add another metric to add into that is your rental yield, which will really help determine, like, is the rental yield sufficient for me to sustain this asset.
And we have a cash flow spreadsheet that we share with our clients, so if you want access to that, just pop us a line. And I hope this was helpful. We look forward to speaking with you soon.